So we talked about the sensitivity analysis. The second type of risk analysis we could do is scenario analysis. And that's where we have the base case, and we assign it a probability, and we have a worst case scenario and a best case. So we've got just three different situations: worst, best, and what we originally expected. And so in our worst case scenario, we're going to assume that unit sales were only $75,000 to start out with. And the best case scenario is that we sell $125,000, or I'm sorry, yeah, we sell 125,000 units. And so if we went into Excel and we let this calculate through to get our NPVs, we would see that we've got our probabilities, and that's something we decided. We decided 25% chance of worst case scenario and 25% chance for best case scenario. We get the three NPVs. We already had the 15, and this is the one even where we were including inflation, because remember, this was a positive NPV when we included inflation. So we can figure out what's the expected net present value because we have probabilities. So you take the first probability times the first expected net present value, and you just do a weighted average, and you get the expected NPV is a positive 15,000. And then you could get the standard deviation, because remember, I forget which chapter it was, but where we had the probabilities and we were calculating standard deviation. So you got the first probability, and then you have the first expected NPV minus the overall expected NPV of 15, what we got here. And that's squared. And then you go to the second scenario and the third scenario, and then you just add those numbers up, take the square root, and you get 30.3 or $30,300. And then to give us some sense of the risk of the project, because we were able to calculate a standard deviation, unlike before, we can calculate the coefficient of variation by taking the standard deviation of the NPV divided by the expected value for the NPV. So it's like the risk divided by the return. And we get a coefficient of variation of 2. And 2 is, you know, it's kind of a little bit of a higher risk type project. Remember, the lower this number, the better. So 2 might be considered a high risk project for this company. And here they give us some information. If the firm's average project's coefficient of variation range is from 1.25 to 1.75, is this project high, average, or low risk? Well, since 2 is greater than the higher number of the range, it would be classified as a high risk project. So the comment that they're making that some sort of risk correction is needed just means that we could adjust the weighted average cost of capital like upwards, make it say 13% or something, and then calculate the net present value and see if even if we've added a higher cost of capital, because we have to increase the weighted average cost of capital for higher risk projects, then see, do we get a positive NPV even after adjusting for risk? And then we have another question. Do we think that this project is highly correlated with the firm's other assets? Well, it is reasonable to assume that if the economy is strong and people are buying a lot of the product that this company is making, then sales would be strong in all of the company's lines. So there would be a positive correlation between this project and the rest of the business. However, each product line could be more or less successful, so the correlation would be less than +1, or a perfect positive correlation. A reasonable guess might be plus zero point +0.7, or within a range of plus zero point +0.5 to plus zero point +0.9. However, remember that just as with stocks, whenever you add stocks into a portfolio that have less than a perfect positive correlation, then we do reduce the overall risk of the portfolio. And this is the same idea for a firm's projects and adding less than perfectly positively correlated projects together in a portfolio of projects that the firm holds. So then they can be diversified as a firm. Now, the next question has to do with if the project had a high correlation with the economy, how would the corporate and market risk be affected? So in terms of corporate risk, if the project's cash flows were highly correlated with the firm's aggregate cash flows, which is a generally reasonable assumption, then the project would have high corporate risk. However, if the project's cash flows were expected to be totally uncorrelated with the firm's aggregate cash flows, or positively correlated but less than perfectly positively correlated, then accepting the project would reduce the firm's total risk, and in that case, the riskiness of the project would be less than suggested by its standalone risk. If the project's cash flows were expected to be negatively correlated with the firm's aggregate cash flows, then the project would reduce the total risk of the firm even more. And then, in terms of for the market risk, in all likelihood, the project would have a positive correlation with returns on other assets in the economy, and specifically with the stock market. If an asset, or like in this case we're talking about a project, has a high correlation with the market, then it has a high beta, and then it has high market risk. Now let's consider another question. I know you're probably getting tired of all these questions, but let's assume that a firm could add or subtract 3% as a risk adjustment for the weighted average cost of capital. Well, if we do this, should the project be accepted? Since the project is, in this case, judged to be above average risk, its risk adjusted or project weighted average cost of capital would be 13%. So we take the 10% plus 3%. At 13%, its NPV would be negative $2,226, so it would not be acceptable. Now, if this were a low-risk project, which it's not, its cost of capital would be 7%, and its NPV would turn out to be $34,117. And this would be profitable based on, well, on a risk-adjusted basis. However, doing this type of numerical analysis may not capture all of the risk factors inherent in the project. If the project has a potential for bringing on harmful lawsuits, then it might be riskier than first realized. Also, if the project's assets can be redeployed within the firm or can be easily sold, then the project may be less risky than the analysis is indicating. And here's a summary of what I was just talking about.